Hey, welcome back. Gold is currently in a very interesting spot. Despite rising to record highs, we are in an environment that could potentially lead to it go up even more. If that happens, gold mining companies, many of which already deliver very good profits, should have even more to gain. Now, there are a few things that make gold quite a unique commodity. You have some real uses that generate some demand, but you also have demand coming from the status point of view, making the potential theoretically unlimited. On the other hand, the downside has a limit because thanks to the physical uses, you have the normal supply and demand balance. We can see the median all-in sustaining cost rise even above 1.4 thousand now, which is yet another record since it was introduced about a decade ago. This is normal, inflation, workforce, oil, energy and so on, but it can have a very significant effect. Back in 2015 to 18, for example, when the cost of producing it was like 900 per ounce, you could of course see gold at 1.1 thousand. Try it now and you suddenly lose like 75% of the production coming from mining. Recycling is also a source, but it accounts for about 20-30% of the supply, so you still depend a lot on the new gold that's taken out of the ground. And don't forget that recycling also has a production cost. Then, when the supply is low, you don't have enough to meet the demand, meaning you get higher offers for what you have and the price goes up. This is the basic commodity aspect. However, the upside doesn't have a limit like a normal commodity where you don't use it or replace it if the price is too high. With half of the demand coming from investing, you have all the market aspects like fear of missing out that can boost it, especially if it goes up. If gold gets to, let's say, 5,000 per ounce, you will hear everyone tell you how good of an investment it is, and this is what makes gold quite unique. You can argue that you can do this with some crypto, but you don't have the real demand acting as a safety net in case it falls because other than, I don't want to call it investing, you don't have another source of demand. Not even silver or platinum are like this. Gold is also one of the few commodities that doesn't depend on China for supply or demand, so they can't artificially keep the price high or low. Although you can have banks or maybe funds that can do that to some degree. Plus, with rate cuts eventually leading to lower treasury yields, gold might become a more attractive option again. With inflation falling and treasuries paying that guaranteed 5-6% yield, gold becomes a less attractive option. But when treasuries get back to around 2%, gold has potential to offer an advantage. Plus, rate cuts have a negative effect on the value of the dollar, which is good for gold and other assets. So gold mining companies could potentially benefit from these higher gold prices and a lower cost of debt, which can be a huge boost. And another thing, if you look at gold miners, as you are about to see, with a few exceptions, they don't really add that much production. A majority of what they do is replacing the current capacity as the mines run out of gold. If you look at lithium, for example, some of these companies plan to triple or even quadruple the production by the end of the decade, and you have a ton of new companies also developing new mines. It's a very small market in comparison, but the amount of investments is relatively very high. With a normal commodity, when you see such an upcycle, you'd have tons of investments and new mines and stuff, but that's not the case for gold. As you are about to see, they prefer doing mergers instead of investing some billions in creating new production. In a way, they are kind of manipulating the future price because their supply in relation to the demand is what makes the price. To begin with Barrick, this is the second largest gold producer with 6 tier 1 gold mines and some exposure to copper, which they plan to double by the end of the decade. Q2 was above expectations with increases in pretty much everything, and they see the second half ramping up production at a lower cost thanks to a few improvements in the mines. The all-in sustaining cost was above average, however, but that's in part the result of higher capital expenditures. Now, assuming normal capex, at this level of production and gold prices, they can probably make well over 3 billion per year. For a market cap of around 35 billion when I'm recording this, that's a ratio below 12. If you look into other gold and especially silver companies, you can see this ratio even above 20, but we'll go through this for every company in the video. But they are expanding, so the capex is quite high. They have a dividend policy based on the net cash position, meaning that a couple of good years without a lot of investments can lead to high dividends for a while. This can sum up to more than what a company that pays based on the profit can do, especially in a time without that many investments. I want to also talk about the amount of shares that they issue because I know that's an argument in the market. Generally, gold companies don't issue a lot and Barrick actually does buybacks unless they do it to buy other companies. Does it mean it nullifies the dividends you get? No, because they use it to buy assets that produce money and you gain from the synergies that are created. In some cases, you can even gain if the stocks they issue are relatively more expensive than the ones of the company they buy. Financially, they are in a very good position, with the cash alone covering the current liabilities almost twice. We can see a ton of assets well above the company's debt. There is about 32.5 billion in equity on a very similar market cap, which is generally a good indicator about the price. By the way, if you enjoyed this type of video, please leave a like and help me reach 3000 subscribers by the end of the year. Now, as I said before, with so many mergers and acquisitions lately, as you are about to see, Barrick might also decide to do it, which they actually hinted at recently. There are a bunch of good potential acquisition targets and I'll talk about a few later in the video. Another thing that might be either good or bad is that the CEO has hinted at a retirement in a couple of years. It's currently uncertain, but maybe we can see a big merger with a company like Agnico and their CEO takes over. So good financials, which is very important for me, good production and a currently above average all-in sustaining cost that's expected to decrease in the second half as the volume goes up. The dividend can also be very significant for longer following an upcycle which would improve the balance sheet. It's not the best company out there, but overall for what they offer, this has been a pretty attractive price. Plus, the exposure to copper can also be handy to have. It's a potential hedge that can provide some relief in bad times. Overall, I like and I own Barrick, and for a while I think it was the best option for the price. Now, after the increase, they are getting a bit more in line with the others, but there are many other interesting gold companies out there, as you are about to see. Again, it's gonna depend on how the price of gold will develop, but they still have potential. This one is actually my largest gold position, especially since I don't invest in the commodity itself. Now, Newmont, this is the #1 gold producer on the planet with several tier 1 gold and copper mines. They recently had a merger with Newcrest, the largest gold miner in Australia, valued at around 26 billion. They also had a nice second quarter thanks to the high gold prices with about 600 million in cash flows. Also noticeable, the all-in sustaining cost was quite high, similar to Barrick's Q2, but Newmont generally has a relatively high production cost. It was very high now, but we can see it in the 1450 area for a while. Together with Newcrest, they can probably make even as much as 5 billion at the current level of gold and production, so they are at a very similar ratio to Barrick. But again, we see much higher capex, so the cash flow is lower. Financially, they are in an okay position, with the current assets well above the current liabilities, but a bit more long-term liabilities than Barrick. The equity is actually a bit lower than Barrick's, despite the market cap being significantly higher. With Newcrest, by the way, they added about 10 billion in equity and up to a billion of cash flows in good times. They have a few cost-saving initiatives, and in the future they want to focus on the tier 1 operations, which are superior from a lifetime all-in sustaining cost and pretty much any other point of view. They plan to sell over 2 billion worth of mines, which I think was very much needed because some of the mines that they have are actually pretty bad and really drag every report down. Plus, they target about $1 billion per year in synergies and productivity improvements, which can be significant. That's enough to sustain the buybacks or almost enough for the minimum dividend. The dividend policy is a bit uncertain at the moment since they had the merger, but normally they pay based on the profit with a minimum of $1 per share. That's currently a very similar yield to Barrick. I own a bit of Newmont, but as you can probably tell already, I think they really need to fix the portfolio. It's okay now, even if it generates higher capex, but when the price of gold falls, this can lead to significant losses. Sure, they can operate them only when profitable, but closing and reopening a mine takes a lot of time plus money, and it may not always be possible from a legal point of view. They can use the money they get to either develop the current ones or buy new and better ones, so the production doesn't have to decrease that much. They aren't a bad company, and if they manage to reach the optimizations and cost savings, this can be very competitive once again. Not a terrible financial shape, they can make good money, and Newcrest was actually a very good company, so there are definitely good things about them. I think this one is more of a matter of management and time, because if they can do it right, there are a lot of very good assets. Plus the exposure to copper working as a hedge. If I had to choose between the two, I'd go for Barrick right now, but Newmont has the potential to improve significantly. Now, Agnico, this is the number 3 gold company on the planet that grew significantly thanks to a couple of recent mergers and acquisitions. By production, they are around 20% below Barrick, so not very far. They have some of the highest quality, safest and low-cost assets in this video. We can see an all-in sustaining cost below 1200, which is exceptionally good in this market. There are companies with mines in much riskier and generally lower cost regions that can't mine that cheap. This would put a company in the bottom 30% by production cost, of which they probably represent a good chunk. The cash flow during Q2 was similar to Barrick and Newmont despite the lower production as a result of the much better margin. They see a bit more capex in the second half as they are developing some projects, which has an effect on the production cost. They also talk about a potential third gold cycle given the current environment. Indeed, this is a quite unique scenario that can be very beneficial for gold. You know, huge fiscal deficits and tons of government debt, inflation, rate cuts, volatility, geopolitical issues and more. Financially, they are in a very similar position to Barrick, with the current assets covering the current liabilities and the long-term debt. However, unlike Barrick, the equity is about half of the market cap, so you pay a lot more for the company's assets. In fact, theoretically, you pay twice as much with Agnico. They pay a very similar dividend to the other two, representing around 800 million. For a 2% yield, this is a very costly dividend. They paid it for close to 5 consecutive decades, but if we see gold prices fall, they'll have to cut it significantly again. That's the problem with the valuation. They simply don't make enough money to ever pay a good dividend at this price. That's quite a lot of money that they can definitely use in a more productive way. But I think this has an overall good management team, and if they get in a position where they have to, they won't make the mistake of not cutting it. Again, it's a lot of money, and if they let it bleed the company, it can ruin the balance sheet fast. So they are higher quality for sure, although I'm not a fan of the dividend, but that can be cut. For that you of course pay a premium, but if you think about it, by the way this company operates, that can be an advantage. They can use the inflated price to buy other companies at a discount. That's how they became actually the second gold company on the planet by market cap. And this is how companies like Alphabet or Amazon fuel their growth. When you can issue at let's say 40x the cash flow and buy companies at 10-20x, you deliver better than the dilution plus synergies. There is even the possibility to see them merge with Barrick, which again at the current prices would be more in Agnico's favor. And since Barrick is looking for something like this and the potential CEO retirement, this would be a, let's say, good ending for Barrick. They would then become the number 1 gold company, but you know, this is just speculation. So overall this is a very good company, but I think that dividend is a bit of an issue for not really that much. But ignoring that, since they can cut it, the price is not really that attractive, although they can use that in their favor. Still, in the current market I wouldn't pay more for Agnico than I do for Barrick. Again, good company and production cost, but you still pay 2 times the equity and about 20x the potential cash flow, so much more than Barrick. But in the current environment, they have a lot of potential to secure capital needed for future development. Now, Kinross, this is a medium-sized gold miner making around 2 million ounces, so around half of Barrick and Agnico. They reported a great second quarter like everyone else, and this is something that we have to keep in mind. Give the market 2-3 more quarters where everyone reports very good numbers and you can see the hype and enthusiasm build up. This would then push the valuations higher and higher, especially if gold prices keep going up. Again, gold prices are important, but the time they stay high is maybe even more important when it comes to the companies. We can see them making 346 million in cash flows, which is very good for this size. They can probably make something around 1 to 1.5 billion per year during a time like today. So this would be a similar ratio to Barrick. By the way, using the nice cash flows, they also repay 200 million in debt, but we'll get to that in a second. The all-in sustaining cost was almost 1.4 thousand, which is quite a bit of an increase, but still relatively good. They are also going to open a new mine very soon, probably in Q3, and the exploration projects are advancing as planned. Financially, they are in a good position, with the current assets covering the current liabilities and not a lot of debt. Overall, you have around 6.5 billion in equity on an 11.5 billion market cap, so in line with Agnico. They also pay a small dividend, but it's quite meaningless. It's also interesting to see, however, that instead of spending 200 million on special dividends or buybacks, they decided to repay the debt. That's probably the optimal thing for the company, and it's something that you don't see that many management teams do, so I'd say this is definitely a plus. In a majority of cases, not only in the gold industry, the management would be like, take this huge 1-2% dividend and don't worry about the company. To be fair, my main issue with this company is that they don't seem to invest in growth that much. Mines have a limited capacity and lifetime, so eventually something has to be done. This brings me back to that argument where a majority of companies do this. If we then see an increase in gold demand and a stable or even decreasing supply, that can lead to a spike. Sure, you can invest in gold without actually buying the commodity through various instruments, but banks and governments and funds with money would require the real thing to at least back the instrument. Many gold companies seem to prefer diversifying into copper, for example, than going all in on gold. But they have one project in development and 2 explorations when others don't even mention those because there are too many. They could use the stock to buy other companies and develop that way if they are smart, but that's a matter of management and it wouldn't add any production to the total supply. Again, you'll see that even for a company of this size, there are good companies they can buy. They could also be a potential acquisition target since the assets are good quality and you can add some solid 2 million ounces in production. The thing is, this company was very attractive when I talked about them at 5-6 billion below equity, but now at 11.5 it's more in between Barrick and Agnico. Still great and with potential, but obviously not the same as when it was at half the price, of course. It's on my watch list as a potential buy if we see them fall enough. I'd say anything around the equity, meaning a price of 5-6, should be okay for me. But I can see even the current price is more than okay for many people. Now Alamos, this might be one of the best gold companies I've ever seen. They recently had a merger and can now make around 500,000 ounces at a very good price. They have the possibility to expand the production to even more than 900,000 ounces and very impressively do it at a lower cost. They expect all-in sustaining costs of around 1,150 this year and around 1,000 from 2026. This would make them one of the lowest cost gold companies on the planet. Even if they remain at the current level instead of reducing it, they would still produce it very cheaply, especially for North America. Even in the near future, they can get to around 700 million ounces, which is a significant increase. They can do that at a very competitive price thanks to a recent merger with a neighbor plus a couple of other developments. They can share everything and maybe negotiate better, basically unifying the two into a single project. They had a very good quarter, like everyone, making a record 107 million in cash flows. That's not amazing for an 8 billion market cap, but there is potential to do even better. Financially, they are in a very good position, with the current assets covering the current liabilities and no debt. However, there isn't that much equity given the current market cap, so they are expensive from this point of view as well. The thing is, this and Agnico are at what I would see as a fair value in this market, the others are below the norm. You know, seeing a company traded even below equity or at 10x the cash flow in such a market and with this potential in the future is pretty unusual. Unfortunately, as good as the company is, the market has already reacted to it. I'd say they are valued similar to Agnico or maybe even above that, so you really pay a lot for quality. Making a quarter of Kinross, but they are valued almost at the same market cap. It could be a potential acquisition target for a company like Agnico, but anyone would have to pay quite a lot for what they can offer. They can also use this valuation to buy other companies, so there is potential. But this one is on my watch list, and if they fall enough, it's definitely a buy. Gold can crash to whatever and this company would probably still make money, but thankfully the stock wouldn't follow in the short term, opening a potential window to buy. But that's assuming that they aren't bought by another company by the time it would happen, so you can never know. Now B2Gold, this is a smaller miner that can produce around 1 million ounces. They expected a bad year in 2024 due to closing a mine and reopening a new one in 2025. They didn't have such an amazing quarter and in fact cut the production outlook due to some equipment availability issues. However, that means the higher grade ore that they didn't mine and process will be done in 2025, resulting in a potentially even better than expected year. Still, they reported a good all-in sustaining cost below average, although they expect it to increase in the second half as a result of the developments. Now, we can see this as a positive because it takes a bad year running below capacity for them to mine at even below what other companies do. Looking at the price, however, we can see that the market really doesn't like this. The price actually kept falling despite the price of gold going up. The capex is up a lot due especially to the new mine and other developments. With normal capex of around 400 million, they could produce even more than $500 million now. That would put them at a ratio of around 6-7, which is even a third of what other gold companies are currently traded at. Financially, this is among the best companies in the video. We can see the current assets well above the current liabilities and very little long-term debt. There is 3.85 billion in equity on a similar market cap depending on when you watch the video. We can see that a majority of the liabilities is in prepaid gold sales and streaming obligations, meaning usually non-cash expenses. They pay them in the future when they mine the gold. My issue is that they depend a lot on the mine in Mali, which obviously has political risk. It hasn't been an issue yet, but it's very uncertain. But for that level of risk, they come with a very nice almost 6% dividend. That's about 215 million, which might be a bit too much in certain environments, especially if they continue the investment cycle. But they are expanding and by Q2 2025 they should produce gold in another mine as well. So the company's overall level of risk is actually getting better and better while the stock doesn't really show it. So I'd say this is a good risk reward for me. Even though a majority of the market went up, they seem to get to lower and lower prices, opening a potentially huge recovery if the company improves. There is risk, but looking beyond the higher capex and current issues, even at 10x the cash flow, this could easily double or even triple. And don't forget that financially, this is among the healthiest companies in the video traded around the value of the equity. So I'd say this is not a very rational price and it's getting even on the undervalued side. And finally, Centerra, a gold and copper miner with 2 mines in Canada and Turkey. I think this is the only company with a mine in Turkey in this video, although that's a pretty high potential gold region. They can make around 400,000 ounces at a very good all-in sustaining cost, below 1,200. Again, the mine in Turkey produces even below 1,000. They had quite a bad year with selling the interest in a mine, no processing at the mine in Turkey and lower grades in Canada. Still, they managed to make quite a lot of money and now, with a negative cash flow in Q2, they would be at a ratio of around 6. But the problem is that they currently depend on 2 mines. Any issue in either of them can decimate the company's production. They actually had some permits issues a couple of years ago which cut the production in half. They even expect the Turkish mine to decrease significantly starting next year as the production cost would increase, meaning they need a replacement. There are a couple of mines they are working at, but that's 4 or 5 years into the future. What they can do is look for a merger or some acquisition because otherwise there isn't that much they can do in the short term to avoid a significant production drop. Financially, this is actually the healthiest company in the video with enough cash to cover all the liabilities. There is about 1.7 billion in equity on a similar market cap, so that's among the good ones in the video. As they show, this is among the healthiest companies in the entire market, so if the price continues to fall to reflect the production drop, someone should definitely be interested. They also pay a pretty good 3% dividend plus a few buybacks. This isn't a lot of money for them, so unless they really want to, it's unlikely to see it cut. Still, that's among the bigger ones in the gold industry for now, which is a bit disappointing given the price of gold, but that's after prices went up quite a lot in some cases. I think there is potential to see them fall even more as the mine in Turkey decreases, and then by the end of the decade maybe see a recovery in production and the stock probably following. They are in the middle of a transition that for such a company is massive. But then, during this transition and when they get close to reaching new production, this could be an interesting buy because, again, there are many good things about them. And the mine in Canada is actually very good. But as good as they seem on the surface, I wouldn't buy now because there are imminent issues that will very likely lead to a lower price for about half a decade. But taking the Turkish mine out and let's say cut the cash flow to 40%, this is pretty much in line with the market right now, so there is short-term potential. I think it's very likely to see someone buy the mine in Canada and the other operations in North America, so I'll keep an eye on them. You can see on the screen a summary of a few important things about each of them. To some degree, all of them can still do well in the future given this environment, some obviously better than the others. For me, the financials are very important because I want a company that can at least do okay if we see gold crash and can survive for enough time to see it do well. Ultimately, any gold miner is a way to get leverage on the commodity plus dividends in some cases. Normally, there is a premium for quality, safety and so on, which is a bit off right now. So overall we can see some discrepancies, but all of them are starting to follow gold to some degree. I made similar videos some months ago and some of the stocks that I cover even doubled from that point, so it's ultimately a matter of time. If gold remains even above 2000 in the long term, all these companies should be in an excellent environment. I have my positions in a couple of companies and they are kind of getting out of the clear buy territory. But with fear of a not so soft landing plus the upcoming rate cuts, gold should still have potential to grow. Back when I made some of the previous videos, gold at 2,500 seemed like a lot, but now, before rate cuts and with fear of a recession growing and everything else that's happening, even 3,000 could be possible. So in such a scenario, gold miners might be some of the best performers in the market, and especially if bought during the lows from a year ago, they have potential to be multi-baggers. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.